Hi, everybody. Welcome to our February 2022 edition of Momi's Monthly Mortgage Moment. We are here with Momi Pointer, as always.
Hi, everybody.
So, hi, Momi. And a lot of news lately about rising interest rates and looking to the Fed looking to raise rates. So let's just jump in and talk about all of that. So
let's dive in. You know what? It's a realistic conversation today, right?
Sure.
And let's dive in.
I feel like we're always realistic, but
we are always realistic, but this one is realistic, but it might not be all the positive news that everybody wants to hear, is what I'm trying to say.
Yeah.
So yeah, let's talk about the Feds raising the rate. So I'm sure people hear about that. And the general population gets really confused, Mike, about what that means when the Feds want to raise the rates. It doesn't mean that the Feds are going to raise long-term rates. Long-term rates are 30-year fixed, 15-year fixed, 20-year fixed. The Feds are going to raise short-term rates, which have to do with lines of credit, like HELOCs that you can get from your bank or credit union, credit card debt, those are auto loans, those are short-term rates. But what the Feds want to do, because remember, we've been talking about inflation for what, a year, 6 months, 8 months?
Closer to a year. That we have had it as part of our discussion. So
as part of our discussion, and now it's at 7.5. As you mentioned earlier, we might as well round it up to 8.
Well, the reality is, if you ask me, and if you ask a lot of people, I think the real inflation rate is probably a lot higher than 7.5 or 8 even, but the way it is measured and comes out and is released by the government, the official number is 7.5. So,
and I agree with you on that commentary. But the Feds want to raise their Fed funds rate to 100 basis points by July 1st, which basically means 1 point. So right now, prime, which is how if you have a line of credit, it's prime plus whatever, prime plus a half or prime plus a quarter. Right. Prime is at 3.25 today. Mm-hmm. If the Feds raise the rate by 100 basis points by July 1st, that means that by July 1st, your Fed fund rate will be 4.25, which is going to affect everybody who has a line of credit that's on an adjustable rate, because that means basically now they'll be paying on that money, 4.25 plus whatever the difference is that their bank is offering, 4.25 plus half a point or 1 point or whatever the case might be. Yeah. It's a big jump. And they're doing it, obviously, as you know, and I know, to head off inflation. Yeah. And to get it lowered. And that's the one way that they can do it, is by raising those rates.
Yeah, I mean, it's definitely a big jump. I'm not saying they shouldn't do it. I'm not saying, it's a tough position to be in. I mean, the inflation has gotten out of control here in a fairly short period of time. We could talk about why that has happened, but we're probably off topic if we go down that route. But yeah, I mean, I think the better conversation for us to have is, what should people do knowing this? Like, what's the best way to position themselves or plan?
Well, so that's actually a great segue into, with not only are the Feds raising their rates, but everybody knows that long-term rates, a mortgage rate, a conventional, an FHA, a VA, 30-year fixed, 20-year fixed, those are also rising, right? Yeah. They have been this whole entire year, even, somewhere into last year, but they've really increased, I would say, in the last 2 or 3 weeks. But what that means is, if you have a line of credit or you have student debt, right? What you still should consider is, you should consider, if you have equity in your home, which millions of Americans have equity in their home, you should consider rolling that student loan debt, your credit card debt, which is what, probably 14% or 21% APR on a credit card that you may never pay down. You're just going to pay interest. You should consider rolling those debts and consolidate it as a cash out refi into your mortgage. Because even if rates go to 4, let's just say 4.25, right? It's still better than having student loan debt for, I mean, I don't know, how long do people usually have student loan debt? Forever, right?
10,
For a long
20
time.
years, something. I mean, yeah, I think it varies and depends, and the rates they have can vary a lot, but yeah.
A lot. And
Yeah.
credit card debt, you know, roll it in. Now, you and I looked it up. We talked about it before we started. I guess on May 1st, student loans are going to have to start be repaid, right? Because I think it was on deferral. because of the
Currently, yeah. I
pandemic.
mean, there's a possibility they could kick that can down the road a little bit more, but right now they are due to go back onto repayment in May.
So repayment is pretty much imminent, even though they're going to may extend it, right?
Yeah, I mean, there's a thought from some people that, all student loan is going to be just wiped out and forgiven, but that, that seems less likely now than it did, during the
A year ago.
presidential campaign,
Yeah,
a year and a half ago. So
yeah, in
I wouldn't
2020.
count on it.
I wouldn't count on it. And if
Yeah.
May 1st is the date that they are looking at repayment starting, we don't know where rates are going to be May 1st. So now is the time to, if you have student loan debt, to start that refi and consolidate it, because rates are still relatively low. They're still going to be lower than your student loans. Same with the credit cards. So the refis I'm doing right now are people consolidating student loans, which is why we're talking about it. I have a couple of clients that are actually refinancing and consolidating their credit card debt that they, again, may never pay off, because even if it's 4%, is lower than 14 or 21%.
Yeah.
And then I've got a handful of divorce refi cash or divorce cash out refi buyouts that are court ordered. And so they have to do it. And then of course, my purchases. And with the rising rate environment, I'm not getting refis because rates are low. I'm getting refis because people are looking at their financial picture and how to best capitalize on it, right?
They have a need. Yeah, they have a need. It's not so much just, hey, we're going to cut a 0.5% or 0.75% off of our current rate. People have some sort of need in those situations. Yeah.
And it was good while during the pandemic, the rates were low, and maybe people were on part-time work because their companies, not laid them off, but, just did part-time or
Right.
cut their hours or whatever. And they needed to save money. That worked itself in very nicely.
Yeah. Okay. So what you're saying then is, because interest rates are going up, people should get divorced and then consolidate that. That's not what you're saying, right?
No, but I am
didn't follow
saying
you there, right?
Yeah,
No.
but I am saying, even though rates are going up, people
Right.
should consider consolidating their debt, mainly student loans.
People in certain situations, yeah. If you have a credit, if you have a student loan at 7.5% or 8.5%,
Yeah.
and yeah,
Is that what the rates are on student? I don't know.
I think it varies a lot depending on if it's subsidized or unsubsidized loan, what kind of loan program it was. So
The other key
I
point
know
is,
some are lower than that, but some can be that high, I believe. Yeah.
well, and the other key point is, if you have a line of credit that you've drawn on, maybe you did renovations or took a line of credit to pay off other bills or whatever the case might be, that line of credit is going to be affected by the Feds hiking the rate, so that your line of credit is going to be a whole point higher by July 1st if they do stick to their plan. And that's a good time. I mean, think about it. If your line of credit goes to 4.5, right, 4.5% by July 1st, you might consider rolling that line of credit and consolidating it into your first mortgage and getting a better than a 4.5 rate now.
Yeah. Fixed so you can plan and have surety going forward, because who knows a year, 2 years from now what interest rates may or may not be. So
yeah. And then exactly, nobody knows. We don't have that magic crystal ball. Hopefully they won't be as continue to rise. But that gets me to another point with the rising rates. And I don't know if you've seen this, Mike. I have buyers that I've had with me for a while, right? That maybe they just couldn't get into a home, because you can attest it's been a crazy market since 2020.
Yeah.
Many of my buyers have been outbid, just plain outbid, right? that, you know, with the raising rate environment and, you know, the crazy prices or how outbid everybody is getting or how houses are being outbid, that it's getting, your purchasing power is very diminished.
Yeah.
I've had people that were pre-approved with me last year that got a raise. Maybe they got a pay raise, but that pay raise is completely wiped out by the rising rates and the rising prices.
Yeah.
You know, so it's like, sorry, you're still pre-approved for the same amount.
Yeah. Or less, or even less.
Or less. And I mean, the sad thing is if you're approved for, let's just say 600,
yeah.
Like you were approved for 600 then, you're still approved for 600 now.
What you can get for 600 now is not what.
Where are you going to buy?
Yeah.
Right.
Yeah. Yep.
Yeah. I don't even know if there's anything for 600 in Orange County.
Yeah.
I'm sure there is, but I don't know where.
I mean, there's condos and townhomes but yeah, there's less and less of that.
Right.
So, yeah.
Right.
Yeah. It's crazy how heated some of these bidding wars have become here. Just this year, like even last year was crazy. It's gotten even crazier here where prices are, you know, last year prices went up kind of 1 to 2% a month over the course of the year. You know, depending on where you were in Orange County, they were up 16, 18%. I mean, some of these prices are going up here 4 or 5% a month right now, which is crazy. And it's part of the reason is because we've had such low inventory. You combine the low inventory with now, hey, interest rates are going to be rising. It's really created an urgency with the motivated buyers right now where, where
they'll just okay, we'll offer it and that's that.
Yeah.
You know, because we want to get into the market.
Yeah.
Yeah, no, I agree. I mean, you might have better knowledge of this, but from my perspective with my buyers, we're talking condos that are being bid up over $100,000 over list.
Yeah.
That a condo. It's crazy.
Yeah. 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 I mean, I'm seeing some single family homes go, you know, and this is the north of 1 million price range, but go for a couple of $100,000 more than list price. So
I heard of one going over $500,000 above list price.
Yeah, it's crazy. So
yeah, I mean, who can buy?
Well,
I mean, it's tough for first-time home buyers, which are a lot of my buyers.
Can be, yeah. Yeah, but remarkably, there's still a lot of buyers out there that are, you know, qualified and able to buy in this environment. So
yeah, absolutely.
Yeah.
Yeah. And it's not, I mean, I don't know what you're experiencing because you do a lot of listings and you have buyers as well. It's not all cash buyers. Remember, there was a time in our market where people were just coming in, it was all cash.
Yeah.
I mean, they're not getting beat out by all cash buyers, right? You're not seeing that, are you?
Not a lot. No, not a lot of that. Yeah.
So still financed buyers.
Yeah.
Yeah.
So
the market's hot.
The market's hot. So yeah, so our conclusion today would be prices certainly been going up pretty dramatically. Interest rates are on the rise and are going to be on the rise. So plan accordingly for that. You know, if you're in a situation where it makes sense to consolidate other debt into your mortgage, even if the mortgage is, you know, it's not what it would have been last year. And, you know, even if it gets up to 4% or somewhere around there, you know, just everybody's got their own financial situation. So
yeah,
don't automatically think, oh, well, I shouldn't do this because interest rates are going up. It still might be a better situation than, you know, having separate student loan debt or credit card or something along those lines.
Yeah, and I always do a debt consolidation analysis, and it's interactive. So it always tells you whether it's a good decision to do it or not.
Yeah.
Whether it makes sense, you know.
Yeah.
I think you've seen those.
Yeah, that's a really cool tool that you have for people.
Mm-hmm.
So,
yeah.
So
perfect.
Okay. Well, that's it for today. Hope everybody got something out of that. We'll be back in March and we'll see where we're at then.
And happy Valentine's Day, everybody. It's on Monday.
Happy Valentine's Day. Happy President's Day.
Yeah.
Happy Lincoln's birthday.
Lincoln.
Whoever's birthday whoever you like.
all
happy to
those.
say. Yeah. So,
Awesome.
okay, Momi. Well, thanks so much.
Thanks, Mike.
All right. Take care, everybody.